Why shouldn't central banks print money for government? Imagine a country where the government can just print money whenever it needs funds. It sounds simple, but it can cause big problems. When central banks print money directly for government spending, it can lead to rapid inflation. This happens because more money chases the same amount of goods and services, pushing prices higher. If prices rise too fast, people's savings lose value, and the economy can become unstable. Central banks are designed to be independent institutions. This means they make decisions based on economic data, not political pressure. If governments could tell central banks to print money whenever they want, it could lead to reckless spending. This is called fiscal dominance, where the government controls monetary policy instead of the central bank. When this happens, inflation can spiral out of control, as seen in countries like Germany after World War I and Turkey in recent years. These cases show how printing money for government needs can cause hyperinflation, destroying people's savings and destabilizing the economy. Most central banks use a process called quantitative easing. This involves creating financial reserves to buy government bonds, which adds liquidity to the banking system. But this doesn't mean money is directly handed to the government or people. It only makes banks more willing to lend money. The real danger is when governments run large deficits and relying on central banks to print money to cover those deficits. That extra money then enters the economy and can cause prices to rise sharply. Having an independent central bank helps keep inflation in check. It focuses on controlling prices rather than financing government deficits. This separation helps maintain a healthy inflation rate, usually around 1.5% to 2.5% each year. When inflation stays within this range, it supports steady economic growth and keeps money valuable. If governments print money to fund spending, it might give a short-term boost to the economy. But if the supply of goods and services can't keep up, prices will jump. This can lead to a cycle of rising inflation that is hard to control. That's why governments should rely on taxes or borrowing from the public to fund their projects. This approach keeps monetary policy focused on keeping inflation low and the economy stable. Printing money for government needs may seem easy, but it can cause long-term damage that outweighs any quick benefits.